Normally in the stock market, the rules of gravity are, well, pretty straightforward.
Right. I mean, a company takes a test every quarter called earnings, and they get their score.
Exactly. And if that score is lower than what Wall Street expected, they get punished and the stock drops. It's clean, it's binary, and it makes sense.
But then you look at what happened this past Friday, and suddenly that gravity just stops working entirely.
Yeah, we are looking at a market landscape right now that is completely defying those basic assumptions.
Yeah.
I mean, the biggest publicly traded uranium producer in the world misses its earnings expectations by a mile.
By a massive margin, yeah.
And the stock shoots up 4% before the market even opens. So welcome to the deep dive, where today we are acting as your audio explainer.
Taking the new Uranium Unleashed report and using it as a roadmap.
Right, a roadmap for the week ahead, specifically the week of August 3rd through the 7th, 2026. We are here to figure out why market gravity just broke.
Well, I'd argue it broke because the market is finally maturing. We're entering what analysts call a digestion week.
A digestion week. Okay, let's unpack this.
Yeah, we just got a massive data dump from that major producer, and there is a ticking geopolitical clock running in the background,
Right. So the core question for you to watch this week is whether the broader market gets distracted by surface-level headlines or if they zero in on the underlying structural mechanics.
Exactly, because to the average observer, a company missing expectations and seeing their stock jump is completely bizarre.
It makes no sense. We are talking about Cameco's Q2 earnings report here.
Right, and Friday's trading action is going to color every single trading day this week.
So I know they missed the mark on the headline numbers, but what exactly was in that report that had traders, hitting the buy button instead of panicking?
Well, the panic would have happened if you only looked at the earnings per share. Cameco reported 13 cents per share.
And the consensus was what, like 36?
36 cents, yeah. On a normal day for a normal company, missing by that much is just a bloodbath. But the metrics that completely overrode that miss was their realized uranium price. They reported selling their uranium at an average of $93.13 per pound.
Which is, incredibly high compared to where we were just a couple of years ago.
Oh, it is massive. That $93 figure beats the current spot price, which sits around $86 right now.
Okay, well.
And it aligns perfectly with the term contract price of $94 to $95.
So they are locking in those higher rates.
Exactly. And to cap it off, they raised their guidance for the full year. They told the market they expect to realize between $91 and $96 a pound going forward.
So the earnings miss had absolutely nothing to do with their pricing power.
Nothing at all. It was purely a volume issue, just lower planned sales and some reduced equity earnings from their stake in Westinghouse.
Okay, I want to stop on that phrase, realized price. Because why is that specific metric the holy grail for a mining company?
If we connect this to the bigger picture, you have to look at how uranium miners actually make money.
Right, I'm trying to think of an everyday equivalent. Is it like selling real estate?
That's a pretty good way to look at it, actually.
Like, say, your profit margin on a house is absolutely through the roof because the neighborhood got hot?
Right.
Does it really matter to your bottom line if you sold one less house this month, as long as the margins on the ones you did sell are breaking records? Is that what's happening here?
That captures the dynamic perfectly, yeah. They don't just sell all their product on the open market day to day. They rely heavily on long-term, multi-year contracts with nuclear utilities.
That's what we call the term price.
Exactly. Right now, there is an $8 to $9 spread between the spot price, what you pay for a pound today, and that term price.
But wait, why the premium on the term price? Usually, if you buy in bulk over a long period, you get a discount.
Not in a market dealing with structural scarcity.
Oh, okay.
Utilities are paying a premium for security of supply. They need to know fuel will be there in 2029 so their billion-dollar reactors don't just go dark.
That makes sense.
For a long time, producers like Cameco were dragged down by old fixed-price contracts they signed years ago, back during the bear market, when uranium was really cheap.
So they were basically obligated to sell at $30 or $40 a pound, even as the spot price climbed up.
Exactly. But that $93 realized price tells us those old, cheap contracts are officially dead and buried.
They have rolled off.
Yeah, the structural tightness of the market is finally bleeding into their actual bank accounts. Cameco isn't just modeling higher prices on a spreadsheet anymore. They are cashing the checks.
And that is why the stock went up.
Exactly. Institutional investors are going to spend this entire week revising their price targets based on the reality of that $93 number. They're completely ignoring the 13-cent EPS miss.
Okay, so if producers are successfully commanding these incredibly high prices, it naturally begs the question, who is paying them?
Right. You don't have a market without buyers.
Exactly. We need to look at the utilities.
Yeah.
And right now, according to the data, a huge chunk of those buyers are sitting in the exact same room this week.
The timing is perfect. The Nuclear Energy Institute, the NEI, is holding its utility working conference right now, August 3rd through the 5th in Seattle.
What actually happens at these conferences? Because I imagine it's not just panel discussions and coffee breaks. Or...
Oh, definitely not. This has to be where the real, off-the-record procurement strategy happens. It is where the most candid conversations in the industry take place.
Just everyone in one room.
Yeah, you have operators, procurement executives, and buyers all in one space, far away from public earnings calls.
So behind closed doors, they are sweating over their inventory levels.
Exactly. They are looking at the $86 spot price and trying to game out the rest of the year.
So the primary demand signal we were looking for out of Seattle this week is behavioral.
Will these utilities step in and buy heavily at $86, or will they hold off, just crossing their fingers that global tensions de-escalate and prices drop?
It feels like a massive game of chicken.
It really is.
But if they do start buying aggressively at 86, that effectively locks in the price floor for the second half of the year.
It completely validates the floor. It tells producers that utilities have finally capitulated to the new pricing paradigm.
And it isn't just private utility executives feeling the heat. The government is stepping into this space with some staggering numbers.
Yes, the Department of Energy's Nuclear Campus program.
Right. They just announced that Utah signed a memorandum of understanding for a site in Tulare County. And the report highlights potential investments of up to $50 billion per campus.
$50 billion. It's massive.
We are also watching Tennessee, specifically around Oak Ridge and Oklahoma, around the old Kerr-McGee operations, for their next moves.
Those are just massive, multi-decade infrastructure signals.
Here is where I have to push back, though. I mean, it gets really interesting, but also a bit skeptical.
Sure, go ahead.
A $50 billion government MOU sounds fantastic in a press release. But isn't $50 billion just a pipe dream until they actually break ground and pour concrete? How operational is this right now?
What's fascinating here is how policy is finally moving from aspirational to operational. You are entirely justified in being skeptical of government timelines, though.
Right, because that campus could take 10 years.
Exactly. The $50 billion campus isn't moving the market this week. What moves the market this week is the teeth behind the policy, specifically the Section 232 domestic content determination.
Okay, walk me through the mechanics of that, because the market is expecting that determination to drop any day now.
So Section 232 is a tool used by the Commerce Department. It classifies reliance on foreign imports as a national security threat.
In this case, U.S. dependence on foreign uranium.
Right. If the determination goes through as expected, it doesn't just encourage buying American, it mandates it by law.
Oh, wow. So it dictates a specific percentage of domestic U.S. origin uranium that utilities must procure.
Yes. So even if that Utah campus takes 15 years to build, the utilities operating today suddenly have a legal quota dropped right on their desks.
The demand becomes immediate and legally binding.
Exactly. Procurement managers will have to scramble to secure domestic supply, completely bypassing the international market for that specific quota.
And based on the Uranium Unleashed data, if that Section 232 hits this week, the beneficiaries are incredibly specific.
Very specific. It's not just any mining company.
Right. It's companies with operations already on U.S. soil. The report points to Uranium Energy Corp., UEC, as a prime example.
Yeah, they have zero debt. They have a producing mine at Burke Hollow in Texas, and they are sitting on $794 million in liquid assets.
The report also highlights Energy Fuels and Uranium One Americas.
The liquidity and the existing infrastructure are the key variables there.
Because they can actually deliver today.
Exactly. When a policy shift forces buyers to pivot instantly, they can't wait for a company to permit and build a new mine over 5 years.
They have to buy from the guys who can literally pump it out of the ground in North America tomorrow.
Right. So companies like UEC are primed to immediately re-rate in value because they are positioned to absorb that mandated demand.
So this intense push to lock in domestic supply, mandating U.S. utilities to buy U.S. uranium, it tells me the government is terrified of the international supply chain.
Oh, absolutely. which flips the coin to the other side of this market equation.
Right. What happens if the actual physical supply of global uranium stutters? We have to turn to the major global producers, starting with Kazakhstan.
Kazakhstan is the elephant in the room. Kazatomprom controls roughly 22% of global uranium supply.
They are the market's baseline, and they have their Q2 update coming out this week.
Right, and according to the report, we are watching three specific things: production volume, realized price, and sulfuric acid supply.
Okay, I want to look at the realized price first because it honestly confused me when reading the data. We just spent the first segment talking about Cameco pulling in $93 a pound. But in Q1, Kazatomprom only realized $61.33.
Right, a huge gap.
How can the two biggest producers in the world be separated by over $30 a pound in the exact same market?
Well, it comes down to geography, state-owned enterprise dynamics, and the timing of their contract books.
So they operate differently than a Western company.
Exactly.
Yeah.
Kazatomprom operates under different strategic imperatives than a purely commercial entity like Cameco. A lot of their volume is tied up in older legacy contracts with Eastern partners, or it's structured differently to ensure steady revenue for the state rather than, maximizing immediate upside. They are working through a totally different book of business.
So they are still dragging those heavy old contracts up the hill.
Exactly. But the bigger issue for them this week isn't the price. It is the physical production.
Which brings us to the sulfuric acid.
Yes, Kazakhstan uses in-situ recovery mining.
Can you break down exactly how that works and why acid is the single failure point here? Because in the report, it sounded a bit like yeast in baking bread.
That's a great way to think of it.
Like you can have all the flour or all the uranium in the world, but without that one specific activator, you're entirely stuck.
The yeast analogy is great, but the mechanics are even more direct. In-situ recovery, or ISR mining, doesn't involve digging a massive open pit.
Right.
Instead, they drill wells into the sandstone where the uranium is trapped. Then they pump a specialized solution, heavily concentrated with sulfuric acid, down into those wells.
And what does the acid do down there?
The acid literally dissolves the uranium right there on the ground. It turns it into a liquid solution that is then pumped back to the surface for processing.
So literally no acid, no dissolved uranium, the entire operation just stopped.
Exactly. And Kazakhstan is struggling to secure enough of it. They have persistent domestic industrial bottlenecks, cross-border logistical hurdles.
And they're competing for rail and pipeline export capacity with the Tenzi's oil field, right?
Exactly, which is the largest oil facility in the country.
So if Kazatomprom comes out this week and announces a Q2 production miss, specifically citing that they couldn't get enough acid.
Or couldn't secure the rail cars.
Right. That sends a massive shockwave through the spot market.
It would immediately constrain output from the world's largest supplier. That's an incredibly bullish signal for global uranium prices.
And the supply fragility isn't just an Eastern problem either. Look at Canada.
Right. Cameco operates Cigar Lake in Saskatchewan, which is one of the massive high-grade uranium mines on the planet.
But operations were suspended back on July 1st due to a surface infrastructure incident. And we still don't have a firm restart timeline.
No timeline yet, yeah. And then there is next-gen energy.
Next-gen is a fascinating variable right now. The report highlights that their Rook I Mine project is currently in its 9th week of the summer construction window.
They've had their construction license from the Canadian Nuclear Safety Commission since March.
Right. But they haven't announced their earthworks mobilization yet. Why is this summer window so critical? Like, why are analysts literally counting the weeks?
Because building heavy infrastructure in northern Saskatchewan is a logistical nightmare dictated entirely by the seasons.
Due to the cold.
Yeah, you are dealing with muskeg and brutal winter freezes. There is a very specific window where the ground is thawed enough to do major earthworks, pour foundational concrete, and move heavy machinery efficiently.
Oh, wow. So if you miss that summer mobilization window...
You can't just start in November. You effectively push your entire baseline supply schedule out by a full calendar year.
That is huge. So a delay at Cigar Lake pulls high-grade supply out of a market today, while a delay at NextGen pushes future supply further out into the late 2020s.
Both scenarios squeeze an already incredibly tight market. It creates a compound tightening effect on supply right as demand is surging.
So we have incredibly tight supply fundamentals colliding with in a vacuum.
No, it all sits on top of a highly volatile geopolitical chessboard that could upend all the math.
Geopolitics is the shadow pricing mechanism of the entire energy sector. You really cannot model fuel prices without modeling geopolitical risk.
Absolutely.
So let's focus on the U.S. and Iran, because the data from the Arms Control Association shows the June 17th ceasefire is fraying badly.
Yes, we're seeing drone attacks on shipping in the Strait of Hormuz.
And U.S. retaliations straining the pause. Now, I want to frame this very carefully for you listening. We are looking at this situation strictly through the lens of energy markets and physical supply chains.
Right.
We are putting aside the politics completely to just impartially report the data provided by the Arms Control Association.
Yeah.
Taking absolutely zero political sides regarding the U.S. and Iran.
Exactly. We're just looking at what this means for the energy markets.
So what does the Strait of Hormuz actually mean for the price of a pound of uranium?
Well, the connection is the perceived risk to global baseline energy. Approximately 20% of all global oil consumption transits through the Strait of Hormuz.
20%.
Yeah. If that choke point is threatened, the risk premium on oil spikes immediately.
But wait, oil isn't uranium. You don't put crude oil into a nuclear reactor.
You don't. But energy markets are deeply interconnected psychologically.
How so?
When oil routes are threatened, the narrative around national energy security accelerates. Governments realize they cannot rely on fragile maritime choke points for their baseline power.
I see.
Nuclear energy, which requires refueling only once every year and a half, becomes the ultimate secure alternative. That macro realization drives capital into the nuclear sector, pushing that $86 spot price higher.
But so what does this all mean for the listener? Is this geopolitical premium just a phantom number traders invent on a screen? Or does it represent a tangible physical floor on the price of energy?
This raises an important question, and it absolutely impacts physical fuel demand.
Okay, walk me through that.
If diplomacy succeeds and a comprehensive nuclear deal is reached, Iran would eventually require heavily monitored, enriched uranium fuel to operate civilian infrastructure under the supervision of the IAEA.
The International Atomic Energy Agency.
Right. So a deal creates net new global demand for fuel.
And if diplomacy fails?
If the conflict continues, Iran remains outside the commercial nuclear fuel market. But the perceived risk of operating global energy supply chains skyrockets.
And that perceived risk forces utility procurement managers.
The exact people sitting in that Seattle conference right now.
Right.
It forces them to stockpile fuel defensively. They overbuy to ensure the reactors are safe from global shocks.
So whether through new civilian demand or defensive stockpiling, the geopolitical tension puts a firm floor under the price of uranium.
Exactly.
And that defensive stockpiling brings us to what the Uranium Unleashed report calls the wildcard confluence for this week.
The wild card.
Yeah, this is a scenario where the supply constraints and the geopolitical demand collide perfectly.
It would be a massive simultaneous demand-side development and supply-side risk signal.
Right, so what happens if NextGen finally announces their earthworks mobilization proving massive new Western development is moving forward? And in the exact same week, Kazatomprom announces a major sulfuric acid supply warning.
That would be a structural validation of everything we've discussed. You would have undeniable proof that Western capital is aggressively scrambling to build new infrastructure.
Coupled with raw data proving that the largest Eastern producer cannot meet its current production goals due to supply chain failures.
The report assesses it as a low probability that both announcements happen in the exact same 48-hour window.
Sure.
But if they do, especially with Cameco's $93 realized price still fresh in everyone's minds, it could trigger a major sector breakout.
It would force the broader market to finally stop looking at the headline earnings misses and stare directly at the structural reality of this supply deficit.
It would be a perfect storm.
All right, so let's bring this all home and summarize the mission for the deep dive this week. You listening are now fully equipped to watch the market like an industry insider for August 3rd through the 7th.
First, watch for analyst upgrades on Cameco, based strictly on that incredible $93.13 realized price. See if the street acknowledges the death of the cheap legacy contracts.
Second, keep a very close eye on Kazatomprom's Q2 update. Don't just look at the top-line production volume, right? Look for the words sulfuric acid.
Absolutely. Third, listen for any off-the-record chatter leaking out of the NEI Utility Conference in Seattle. We want to know if those procurement managers are capitulating and stepping in to buy at $86.
And finally, monitor the Strait of Hormuz. Watch the U.S.-Iran situation strictly for how it impacts the defensive stockpiling mentality of global energy buyers.
It is a complex web of moving parts, from chemical shortages in Central Asia to policy mandates in Washington, but they all point toward the exact same underlying shift in how the world values baseline power.
And why does this matter to you as you go about your week? Because these behind-the-scenes metrics dictate the stability, the security, and ultimately the cost of the global energy grid that powers your everyday life.
Exactly.
The price of a pound of uranium, the availability of industrial acid in Kazakhstan, domestic content laws in D.C.
Yeah.
When you flip a light switch, you are participating in the culmination of this exact market.
Which leaves us with a rather profound final thought to consider this week.
Let's hear it.
We are currently witnessing a massive, coordinated global push toward electrifying everything. Our cars, our home heating, the massive data centers powering artificial intelligence.
Right. Everything needs more power.
But if the supply chain for a fundamental baseline energy source like uranium is so hypersensitive that a shortage of a single chemical in Kazakhstan or a localized surface incident at a mine in Canada can ripple entirely through global power markets.
Wow.
How resilient is our broader push toward electrified infrastructure? We're building a high-tech future on a global supply chain that is startlingly fragile.
That is something to think about. We started this deep dive talking about how the gravity of the market felt broken, how the math of an earnings miss didn't match the stock price going up.
Right.
But when you look closely past the headlines, the gravity hasn't stopped working at all. It's just that the market is finally weighing the deep structural reality over the surface level noise. Keep your eyes on the acid, keep your eyes on the realized price, and we will see how this critical week unfolds.